December 1825. The Bank of England, the most powerful financial institution on earth, is counting its last gold coins. By tomorrow morning, they'll have nothing left to give desperate customers pounding on the doors. 70 banks have already collapsed across Britain. Riots are breaking out in the streets. The entire British economy is hours away from complete destruction. And it all started with a lie about a silver mine 6,000 miles away in South America. To understand how Britain nearly destroyed itself, we need to go back 3 years earlier, 1822. Napoleon is defeated. The wars that consumed Europe for a generation are finally over, and British investors are looking for the next big thing. They find it in Latin America. Spain's colonies, Mexico, Peru, Colombia, Chile, are breaking free and forming new nations. And these new governments need money. Lots of it. They're selling bonds. They're offering mining concessions. They're promising returns that make British government bonds look pathetic. A revolution in mining technology, the steam engine, means that ancient silver and gold mines abandoned by the Spanish could now be profitably reopened. British newspapers fill with stories of unimaginable mineral wealth just waiting to be extracted from South American mountains. The speculation starts reasonably enough. A few adventurous investors buy bonds from the new Colombian government. They make money. Others notice. Soon everyone wants in. Between 1822 and 1825, British investors poured over £20 million into Latin American schemes, equivalent to billions today. 6 new countries issued bonds in London. 26 mining companies were formed to exploit South American resources. Most had never seen the mines they claimed to own. Some of the mines didn't even exist. One company sold shares in a project to drain the Red Sea and recover the gold the Egyptians supposedly lost chasing Moses. Another promised to establish a colony on an Antarctic island. People bought shares anyway. The Bank of England, Britain's central bank, watched this madness and did something catastrophic. They encouraged it. In 1822, they cut interest rates and began lending freely. Easy credit flooded the system. Country banks, small regional institutions, could borrow from the Bank of England and lend to anyone with a pulse. They did exactly that. If you wanted to buy shares in a non-existent Colombian silver mine, your local bank would happily lend you the money. Britain had never seen anything like it. Stock prices doubled, then doubled again. New joint stock companies formed every week. By 1825, over 600 new ventures had been launched, most absolute frauds. The problems started slowly. In early 1825, a few Latin American bonds stopped paying interest. The governments were broke, the mines weren't producing, and the promises were lies. Investors started asking questions. Share prices began falling. Then, in September 1825, a major banking house, Sir Peter Pole and Company, quietly admitted it was insolvent. They'd lent enormous sums against Latin American securities that were now worthless. The Bank of England rushed in to prevent panic, lending Pole and Company enough to stay afloat temporarily. It didn't work. Within weeks, the secret was out. If Pole could fail, anyone could fail. October 1825. The panic truly begins. Investors rush to their banks demanding gold in exchange for their paper notes. This is the era before deposit insurance, before regulations, before safety nets of any kind. If your bank fails, you lose everything. Smart depositors try to get their money out first. Country banks across England face runs. Remember, these banks had lent recklessly during the boom. Their assets, loans secured against worthless Latin American stocks, couldn't be converted to cash. Bank after bank slammed their doors shut. 60 banks failed in the provinces. Businesses couldn't get credit. Factories shut down. Workers rioted. By December, the panic reached London itself. Now the crisis becomes existential. When country banks failed, they'd been holding Bank of England notes as reserves. Those notes flooded back to London as panicked holders demanded gold. The Bank of England, the lender that was supposed to save everyone else, was running out of money. On December 14, 1825, the bank's gold reserves fell to just £1 million, a catastrophically low level. Depositors surrounded the bank's headquarters on Threadneedle Street. The directors gathered for an emergency meeting. Britain's entire financial system would collapse within days, maybe hours. One director later wrote that they were within 24 hours of having to stop all payments, which would have meant the end of the bank itself. What saved them was almost comical. The Bank of England had recently withdrawn all £1 notes from circulation, replacing them with gold coins. This had accelerated the crisis. People wanted coins, not paper. Desperate, the bank's officials literally ran to their attic storage and found a forgotten box of old £1 notes, never destroyed, just stored away. Hundreds of thousands of pounds worth. They rushed them back into circulation. The symbolic effect was immediate. If the bank had paper money to give out, maybe they weren't actually about to fail. The psychological tide turned, just barely. Simultaneously, the government announced it would guarantee the bank's stability with public funds if necessary. The run slowed, then stopped. The aftermath was devastating. 73 banks ultimately collapsed. Thousands of businesses failed. Unemployment soared. Britain entered a brutal recession that lasted years. The human cost was enormous. Families ruined, savings wiped out, lives destroyed. But the financial revolution was perhaps more significant. The crisis of 1825 forced Britain to completely rethink banking. The Bank of England officially became the lender of last resort, responsible for preventing systemic collapse. New regulations limited the kinds of banks that could issue currency. The government began supervising financial institutions for the first time. The modern concept of central banking, a powerful institution that manages monetary policy and prevents panics, was essentially invented in response to 1825. The international implications were equally profound. This was the first truly international financial crisis. The speculation originated in London, but involved Latin American governments, European investors, and global commodity markets. The crisis proved that the world's financial systems were now interconnected in dangerous ways. A bad loan in Peru could destroy a bank in Newcastle. This pattern, speculative bubble, easy credit, international exposure, sudden panic, devastating collapse, would repeat throughout history. You can see it in 1929, in 2008, in every major crisis since. The Panic of 1825 was the template. Here's what's remarkable. Despite its significance, almost nobody remembers the Panic of 1825. It's overshadowed by later crashes. But the lessons are identical to what we face today. Easy money creates bubbles. International investments carry invisible risks. When trust evaporates, even the strongest institutions can fail in hours. And the gap between what people think their assets are worth and what they can actually sell them for, that gap is where financial systems go to die. The technologies change, the countries change, the specific assets change. The human psychology driving the madness remains exactly the same. The Bank of England survived 1825 by minutes and luck. They learned, they adapted. They created the institutions that would prevent the next panic from becoming apocalyptic. But preventing panic entirely? That's proven impossible. Because as long as humans can dream of getting rich quick, someone will sell them that dream. And when enough people believe it at once, the dream becomes a bubble. And every bubble eventually meets reality. Stories like this one remind us why financial history matters. Subscribe to the Panic Index, 3 to 4 new videos every week, each one revealing how the past predicted the crisis we face today. The patterns are already repeating. The question is whether we'll recognize them in time.